Hi everyone, welcome to today's class. So we are going to continue looking at some questions on cost of capital, basically cost of equity. So what we have learned so far is time to do to solve some questions on it, and then in order to practicalize what the formulas we have been given on cost of capital, cost of prevention, and cost of debenture. So today we are going to continue on cost of equity. Now, we have this question here, which says, Valuation PLC is financed with 2 million ordinary shares of 1 naira each, with a current yield of 15%. The company's constant dividend of 20 kobo was paid recently. Required determine the company's share price. Now, the first step in solving a question, and any question at all, is to know what you have to calculate. Here we are told to do what to compute to determine the company's share price. What is the meaning of the company's share price? Meaning that you have to compute the company's market value. In that wise, therefore, I always advise my students, no matter how lengthy a question is, if you are able to do what, to break it down and bring it and summarize the question is partly solved. Another thing we need to know is that we need to know the formula to use to solve a particular question. Once we have known the formula to use to solve a particular question, and the question is solved, there's only way we don't know the formula to use to solve a particular question that it tends to give us what problem issues. You're going to encounter issues. But once you know the formula, once you can digest the question and bring out the formula to use and know the formula to use, the question is what partly solved. So therefore, in this case now, we have to compute the company's share price. What is the company's share price? Market value. That is market value. You have share price, you're talking about market value. In that wise, and the formula we have been given, we are used to, is to do what? Is to compute cost of equity. You say cost of equity, those are formula we're given to us. Cost of equity is equal to DO and stuff like that. So don't worry, we are still talking about the same thing. We are still saying the same thing here. So having a question like this, the first thing you need to do, what I normally advise my students to do, is to go straight to the dividend. The first thing is to go straight to the dividend mentioned in that question. To know why are we going to declare, why are we going straight to the dividend? Is to determine whether the market value given to us, fine. In this question, we are not even given market value. We are not even given market value. So there's no need of determining whether the market value is COMBIF or SD. As we are told that the market value to use in solving question under cost of equity, market value must always be what? Must always be SD market price. But in this case now, we are looking for market value here. So there's no need of computing to determine, to look at whether the market value is, because we are not even giving the market value already. So let's go straight. So let's add our formula. Okay, having known that there's no market value, that's the market value is market value we are looking for here. The next question to ask yourself is there any growth in this question? Is there any growth in this question? Because if there is growth, that is when you are going to know the formula to use in solving this particular question. You know, we have different form of formulas. We have the cost of equity is equal to, these are the formulas in which we have. We said cost of equity is equal to DO given here 0 over market value. We also said we have D0, 1 plus G over market value plus G. We also said we have D1 all over market value plus G. So these are the formulas we have in solving question on cost of equity. Now, out of this question now, which of these formulas are we going to use to solve a particular question? Now, the next thing is to ask ourselves, is there growth in this question? Now, looking at the question, it's obvious that we don't have any growth here. We don't have growth specifically, and we don't have any information relating to growth there. So therefore, we cannot use this formula, And besides, cannot use this formula, you cannot use the other formula. Now, the area of dividend, how do we now know whether it is, we know that there's no growth, fine, there's no growth there. So another formula is, okay, after that one we still have KE is equal to D1 over MV. At this point now, we can see that there is no growth in the question, so this formula cannot go, this formula cannot also go. We are left with this formula and this formula. Now the next question, which formula are we going to use out of these two then? So therefore, now let's look at the formula, let's look at the dividend mentioned in the question. Is dividend given to us, is it dividend now in year 0 or dividend in year 1? Look at the question. It said recurring yield of this. The company's constant dividend of 20 kobo was paid recently. In the introductory part of this cost of capital, we told us those yardstick in which is going to do what led us to know whether the dividend given to us is dividend in year 0 or dividend in year 1. So with this now was paid recently, this was paid recently, is indicating that the dividend given to us is dividend in year 0. And now therefore, the formula to use is what? Is this. This is the formula to use. So we don't need these formulas. We don't need all these formulas here. If that is the case, we are left with this formula. So let's now compute our cost of market value. So you should compute what? Determine the company's share price. What is the share price I'm talking about? This is market value I'm talking about here. The share price is the market value. So, what is our cost of equity? I've said it before that when you hear current yield, that is the yield on investment. That's what the investment are yielded. It means that's the what cost of equity. So 15%, that is what 0.15 is equal to dividend. What is the dividend in the question? Dividend given to us in the question is what? 20 kobo. That is what 0.2, 20 kobo. All over market value, we don't know. That is the variable. That's what we are looking for. That's the unknown variable. That's what we are looking for here. So having get to this point, what is the next thing to do? One thing else to do, we have to do what? Cross multiply. Do what you cross multiply. Do what you cross multiply. So by that, when you cross multiply this, we can multiply this by this. So we have 0.15 MV is equal to 0.2. So we are looking for this for market value, which is the market value. Also, what next? You do what? Divide both sides by the coefficient of MV. So divide both sides by the coefficient of MV. So what is it? So we have 0.15 market value MV all over 0.15 is equal to 0.2 all over 0.15. So this will go to this. So our market value is equal to, what is it? Press your calculator when you have this 0.2 divided by 0.15. So we have it to be 1 naira 33 kobo. So we have to be what is in value, is market value. Market value, so it will be in naira, in currency form. So 1 naira 0.33. So these are market value here. That's our market value. That's the market value. That's the market value. Now guys, that is the question. That is one of the solutions to the question on cost of equity. Cost of equity, from there we compute our what to market value. Market value. So let's look at another question. So anyone that is not clear, please in your comments, please you can put it in your comments so that you're able to know how to tackle it. Or you can see me when you need further explanation, you can see me, you can contact me so you know how to address it. So another question, let's look at this. It said Manchester PLC. Manchester PLC is financed with 3 million ordinary share of 1 naira each, of 1 naira each, of 1 naira each, with current yield of 9%. 9%. Let's go further that the company will pay 25 kobo dividend next year. And the dividend is expected to grow at a rate of 5% per annum in perpetuity. Required to determine the share price of Manchester PLC. Okay. Now is a question. This is another question. Question is what Manchester PLC is financed with 3 million ordinary share of 1 naira each, with current yield of 9%. The company will pay 25 kobo dividend next year, and the dividend is expected to grow at a rate of 5% per annum in perpetuity. Required, determine the share price of Manchester PLC. Here, we are also to determine the market value of Manchester PLC. Just the formula you know. You don't need to do what to be looking for formula here and there. Just write the formula you know. I mean, the cost of equity formula that you know. Just put it down. From there, you start to do what to substitute. The market value will avail itself. Okay, so let's follow our steps in solving the question. So we don't need to be writing all the formulas here again. So by looking at the question critically, we tend to know the formula to use. Okay. Now, the first question to ask ourselves is there any growth in this question? Okay, let's look at it. Manchester PLC is financed with 3 million ordinary share of 1 naira each, with current yield of 9%. The company will pay 25 kobo dividend next year, and the dividend is expected to grow. As you can see, it's expected to grow at a rate of 5%. Yes, per annum in perpetuity. It means there is growth in this question. And that one is therefore, when there is growth in this question, it means you are going to use the formula that has growth. Okay, let's now look at it. The formula that we have ascertained the first thing, we are going to use the formula that adds growth. Now let's now look at the tune of the dividend. Whether we are going to use the formula with D0 or D1. The company will pay 25 kobo dividend next year. Look at the word next year. The company will pay 25 kobo dividend next year. Can you see that? Yes, it means the formula we are going to use here is what with D1. Next year means fusion. In year 1, because year now is what year of investment. That is year 0. That's how we have the dividend as D0. That's year of investment, which is year 0. So next year will be year 1. Okay, so there's growth there as well. So let's write it out. KE, cost of equity, is equal to okay, D1. So D1 all over market value plus G, because there's growth there. So we're going to put 1 plus D here because it's already D1. Okay, now what is our KE? Our KE is what? Current yield. Current yield is our KE. So that is what? 0.09 is equal to dividend of 25 kobo. That is 0.25. 0.25. Market value we don't know. Plus, what is our growth rate? The growth rate given to us is what? 0.5. 0.05. That is 5%. Okay, so what are we going to do from here? What are we doing from here? Just a matter of what? You can do two things here. You can multiply this by this and this by this by expanding, or you can collect the lifetimes first, bring this to this point, because these are the lifetimes, collect the lifetimes. So in the process of collecting the lifetimes, you need to be writing it again. You are material class. So we now bring it down here. That's another one. 0.09 minus 0.05 is equal to 0.25 all over market value. So what do you have? 0.09 minus 0.05. That's what? 0.04 is equal to 0.25 all over market value. So we now cross multiply. What are we going to have? Multiply this by this, we have what? 0.04 MV is equal to 0.25, there's points here, 0.25. Okay, this is multiplied by this, so we make that one here, there. If that is the case, our market value, looking for market value, so you divide the coefficient of market value by both sides. So now we're having V is equal to, now we're having 0.04 MV all over 0.04 is equal to that is 0.25 all over 0.04, which is equal to, what is that? Let's press our calculator. 0.04 to 0.25 divided by 0.04. What do we have in naira value? That is it. We have what? 6.25. That is what? That gives us what? 6 naira 0.25. 6 naira 0.25. That's what we have there. So that is market price of the equity. Market price of the shares. When it says shares, we are saying the same thing. Shares is the same thing as equity. So that is the question. Very simple. Very simple questions. Very simple questions. Now, let's now, often saying this, there are some cases, in most cases, the examiner will not give you what the growth rate. This growth rate that we are given here, the examiner will not give you the growth rate. You will be expected to calculate the growth rate yourself, to determine the growth rate yourself. You will be expected to determine the growth rate yourself. In that way, therefore, let's now look at computation of what? Question and solutions on what? On computing growth rate. On computing growth rate. On computing growth rate. So, on computing growth rate. On computation of growth rate. Okay. We are still under cost of capital anyway. So, computation of growth rate. Okay. Now, let's look at this question on computation of growth rate. You said Salah PLC has been paying dividend. Has been paying dividend in the following pattern. Okay. So we have years. We have dividend paid. So let's say year 2011. In 2011, we paid 20 kobo dividend. 2012, we paid 22 kobo. 2013, 24 kobo. 2014, 26 kobo. 2015, 28 kobo. 2016, now paid 30 kobo. Okay, you are required calculate. So calculate the dividend growth rate. Yes, this is the requirement of the question. You can see, you say want to computation of growth rate. So Salah PLC has been paying dividend in the following pattern. Dividend, 2011, 12, 13, 14, 15, 16. We have 20 kobo and so on and so forth figures. We now have to do what? To calculate the dividend growth rate. Here, we told us we have two methods of computing dividend growth. Dividend growth rate, determining the growth of dividend. The first one is what? Dividend valuation model. While the second one is what? Gordon growth model. Dividend valuation model and Gordon growth model. If that is the case, the question to ask ourselves is what? Which of the formulas are we going to use to do what? To compute this growth? Which of the two formulas mentioned are we going to use? You can see our previous videos on the explanation for computation of dividend growth. You can see some of the videos you have done in the past. So we have it there. So let's go. So now, which of the formulas are we going to use to do what? To compute the growth rate here. Now, looking at the question, you can see this question is given to us. The question is, this is a tabular form. The dividend given to us here is given in what? In a tabular form, in which we have years and what dividend in that respective years. If the dividend is given in this form, the information here is telling us that we are going to use the dividend valuation model. Dividend valuation model. The dividend growth model to do what? To compute our growth rate. Why? Because we have what number of years given to us in this question. You look at the formula given to us in what? Under dividend valuation model. What do we have there? This is the formula given to us. These are the two formulas we have. Anyway, Formula 1. we have n, these are the two formulas given to us, n minus 1, current dividend all over base year div, current year dividend or base year dividend, everything minus 1. Or this one can still be what? Be written as what? N current year dividend all over base year dividend, everything minus 1. You can see my square root does not cover the 1, or the 1 is standing alone. Okay, so why the Gordon growth? The Gordon growth formula for calculating dividend is what? G is equal to what? R times B, R dot B. B is what? R times B. Now looking at this, these are the two formulas we have. Either this or this. Okay, looking at these formulas now, which formulas do you think you can use to go to compute our dividend growth share? Definitely easy, because we are given number of years. Yes, 1, 2, 3, 4, 5, 6. Number where n is equal to number of years. 1 is 1. Current year dividend is what? So the current, this is the current year here. This is the current year. So these are current dividend. So therefore, this is the formula we are going to use. This formula. So it's not dividend growth, it's not Gordon growth. The R year under Gordon growth is what? Return on investment. Return on investment, that's what? R. When we get there, we are going to get to the place we are going to use the Gordon growth, we are going to explain that. Now, let's now focus on this. Out of these two formulas, which one are we going to use then? Out of this and this, which formula are we going to use to go to compute our growth rate here? The formula to use is what? Is how do we determine the formula to use? Now, this is how to determine the formula to use. Where you are given your dividend and year in a tabular form like this, the formula to use, when you are given a tabular form like this, year 1, 11, 12, and so on, anyhow. So the formula to use is what? Is the first one here. The formula to use is the first one here. So when we get to a situation where we are going to use the formula, we are going to expatiate on that. So now let's quickly move on. Having established the formula to use, which is this, so let's run this. Yes. So this is the formula we are going to use. So it's equal to our growth rate, our G is equal to n. What is n? Number of years. N means number of years. How many years do we have here? 1, 2, 3, 4, 5, 6. That is 6. 6 minus 1. 1 is constant. What's our current dividend? Current dividend is 30 kobo. 30 kobo. 0.3. 0.3. 0.3. The kobo is what? Over 100. Divided by 100, you are going to have what? 1, 2. That's 0.3. All over base year. What's our base year? Base year means the first year. Which is this? That's 0.2. As I've said, everything minus 1. The 1 must be standing alone. The square does not cover the 1. So our G is equal to 6 minus, we have it this way again. 6 minus 1, 5. So this divided by 0.3. 0.3, let's check it out. 0.3 divided by 0.2. What do we have? 1.5. 1.5. We have 1.5 minus 1. Minus 1. Minus 1. Having said that, now hope you know how to we now have what? Root 5 1.5 root 5 1.5 what? Root 5, and this one is the fifth root of 1.5, and you get the answer minus 1. So in our next video, we are still going to do a video on how to compute, how to find the root, any root that is greater than 2. You know, the square root. If this one is not there, it becomes square root. But in the case whereby the root is more than 2, this is where I say 3, 4, 5. I will show us in a video on how to press our calculator, on how to use our calculator to use in order for us to be able to calculate the root. In this case now, we have what this is 1.5, root 5 of 1.5. You want the fifth root of what 1.5. How do you press our calculator? I'm going to show us. But in the long run, the answer we will be having here is what? The answer we're going to be having here. Let me press my calculator. So the answer we are going to be having here will be 8.45. 8.45. Okay, 8.45. 8.45%. That's it. That's our growth rate here. That's our growth rate. As I said, we do a video where it's going to show us how to press our calculator to look for the fifth root or any root you are given. If it is not a square root, it will show us that. Okay, that is question on what? Determination of growth rate. Now let's look at another question. Let's look at another question on growth rate. On growth rate. Okay, so question 2 on growth rate. Money. Don't mind me, I like the football player. Very strong. Money PLC, that's the money. Money PLC. Paid dividend. Paid dividend. Paid dividend of 15 kobo. Last week. And 10 kobo dividend was paid 4 years ago. 4 years ago. Was paid 4 years ago. Required determine the growth rate. Of Money PLC. Okay. Now, looking at this question on computation of growth rate, we are told that the question reads us: Money PLC paid dividend of 15 kobo last week, and 10 kobo dividend was paid 4 years ago. Required determine the growth rate of Money PLC. We have to determine the growth rate of Money PLC in this case. So, now, which of the formulas, the question to ask yourself is, which of the formulas are we going to use here? Are we using the Dividend Growth or we are using the Dividend Growth Valuation Model? Okay, we cannot use the Dividend Growth because we are not given return on investment and retention rate. Fine. Now we are given, it is what Dividend Valuation Model we are going to use to solve this question. In other words, out of the 2 questions given to us, which of these 2 formulas are we going to use then to solve this particular question? Now, you can see the formula, the previous question is originally solved. The dividend given to us was given to us in what? In tabular form. But look at this. This dividend was not given to us in tabular form, but it was just mentioned that what? Money PLC paid dividend of 15 kobo last week. Recently paid. That's last week. That's the current dividend. And 10 kobo dividend was paid 4 years ago. required to determine the growth rate. So therefore, without wasting our time, the formula to use here is what? You can see we have current dividend and what? Current dividend and base year dividend. So it's solved. So from there we know that the formula to use, and besides you are not given in tabular form. It's only when you are given in tabular form you are going to use the n minus 1. But in this case we are not given in tabular form. So we use the second one, which is what? N current dividend minus base year dividend or base year dividend now minus 1. Now, how do we now G? So G is equal to, what is our N in this case? What is our N in this case now? How do we now determine our N? Yes, we can determine our N from the question. Just look at the tune of the question. One PLC paid dividend of 50 kobo last week, and 10 kobo dividend was paid 4 years ago. Look at it, 4 years ago. 4 years ago. In a case whereby you are not given the dividend in tabular form, you are just given the current dividend and the base year dividend. Just pay the 4 years, the number of the years ago in which they have paid the dividend, just pay the 4. Okay, let me take it again. In a case whereby you are not given in tabular form, this is formula to use. Now the question is, how do we now know the N to use here, the number of years? You can see, you are told that what 4 years dividend and 10 kobo dividend was paid 4 years ago. So the number of years in this case is what? Just pick your 4 and use it as your N. In another form, to interpret this question, before we can be talking about what 4 years ago, look at it. They said 4 years ago. Because we can be talking about 4 years ago, it means we are in year 5 already. Does it make sense? Yeah, they said 4 years ago. It means for us to be saying 4 years ago now, it means we are in year 5. It means the current year is what? Is year 5. Okay, for example, I said we are now in year 2020. 2020. This year we are in year 2020 now. I said 4 years ago. What does that imply? What does that imply? It means if I want to count here 4 years ago now, I will count it back 4 years. At this what? 19, 18, 17, 16. I think that is 4 years ago. So I'm in year 20. So if I'm to count it together, 16, 17, 18, 19, 20, that is 5. So 5 minus 1, you are still coming back to this 4. That's the implication. If I said 4 years ago, it means we are in year 5. So it's still coming back to the other formula, which is what? N minus 1, which is now what? 5 minus 1 to give us 4. So that's just a simple explanation as regards to that. So therefore, when you are given direct like this, just pick your 4, just put it there, just use it direct. Just use it direct. So by that, we have been having 4 here. So our current dividend is what? Manifest, okay, that is 0.15 all over dividend paid 4 years ago, that which is base year dividend is what? 0.1, everything minus 1. So our G is equal to, okay, so for what is 0.15 divided by 1. Okay, so we still have what? 0.15. Okay, 0.15 divided by 0.1. Okay, we have 1.5. 1.5. 1.5. That's what we are going to have. Yes, that's what we're going to have. 0.15 divided by 0.1. So we are going to have what? 1.5. So what is now the fourth root of 1.5? The fourth root of 1.5, as I've said, we are going to do a video on how to press our calculator to look for the fourth root or any root given to us. So we now press it. Yes, fourth root. So we will be having minus everything minus 1. Don't forget, we have to put a minus 1 there. Minus 1. So now we're having, the answer we're having is what? 10.67. 10.67. So 10.67%. 10.67%. 10.67%. So that is it on how to compute growth rate. Growth rate. Yes, we said we also have two methods of computing our growth rate. So let's now look at the Gordon growth. Let's take one example on the Gordon growth on how to calculate our growth rate. Gordon growth. Gordon growth. Gordon growth. So, question 3 on Gordon growth. So, club PLC. I'm a Liverpool fan, don't mind me. Club PLC is a company. With 20 million ordinary shares of London Club, so of $1. Let's use $1 per share. $1 per share. Currently quoted, okay? Currently quoted at $1. Okay, we write it at $1.20. $1.20. The company has a policy of retaining 55% of its earnings. And normally achieve 20% return on investment. The company's current dividend of 25 kobo was paid recently. You are required to calculate the company's cost of equity, the company's cost of equity. Okay. Now, we are computing. This is a two-in-one question. This is a two-in-one question where you are going to simplify. The number one question is we are going to determine our growth rate. At the same time, we are going to compute our cost of equity. Okay, let's analyze the question and see. If you look at the question very well, the requirement of the question is to compute the company cost of equity. To compute the company cost of equity. Now, in computing our cost of equity, the basic question we need to ask ourselves: which of the formulas that we know are we going to use to compute our cost of equity? As we know, we have various different formulas. Or which of these formulas are we going to use to compute our cost of equity here? Okay, let's look at the question in order to know the formula to use. For you to know the formula to use, look at your what? Look for growth. Do you have growth rate in this question, or is there any information that will enable us to compute our growth rate in this question? If you can see growth rate or anything that will enable you to compute your growth rate, it means you are going to use any of the formula with what? With growth. Okay, now the next question is it D0 or D1? Is it the formula with growth rate which has what? D0 or D1? Now let's now look at the dividend. Let's now look at the tone of the dividend. Pro PLC is a company with 20 million ordinary share of $1 per share, currently quoted at $1.20, $1.2. The company has a policy of retaining 55% of its earnings and normally achieve 20% return on investment. The company current dividend of 20 kobo was paid recently. Now, these are the things to watch out for. Current dividend. Current dividend. It means we are going to use the formula with D0 because it's current dividend. Okay, so KE is equal to D0. Okay, what about, is there growth in this question? Now to know whether there is growth. Okay, if you now look at it, the company has a policy of retaining 55% of its earnings and normally achieve 20% return on investment. It means there is growth in this question, but we are not given directly like that. It means you are going to compute your what? Your growth rate. You are going to compute your growth rate using the Dividend Growth Model. Because in this case, we don't have the current, they did not give us, okay, fine, we have the current dividend, but do you have base year dividend? In order to tell us whether they are going to use the dividend valuation model. We don't have the base year dividend, but we have the current dividend. So therefore, we are going to use the Dividend Growth because we have retained on earnings, policy of retaining 55% of its earnings. That's what retention rate. In year retain, that is retention rate. And return on investment of what? Achieve normally at 20% return on investment. So therefore, let's compute our growth rate here. Let's compute our growth rate here. So growth rate. So G is equal to R times D. That is Dividend Growth. Using Dividend Growth, where our G, which is the growth rate, is equal to what is R? R is what? Return on investment. R is what? Return on investment. R. Let me run this. G is equal to growth. G is equal to growth. R is equal to return on investment. B is equal to retention rate. Retention rate or rate of retention. Okay, so let's now go. G is equal to G is equal to So G is equal to R. What is our return on investment in this question? Return on investment is, okay, come as the policy of retaining, that's retention, which is B. So return on investment, 20%, that is 0.2. 20% is what? 0.2. 0.2 times B, retention rate. What's our retention rate? 55%, that is 0.55. That is 0.55. 0.55. 0.55, which is equal to, let's compute it, let's have it. Let's have it. 0.2 times 0.55. So we have 11%. Is equal to 11%. So that is the growth rate. That's the growth rate I'm going to use here now. Let's make the formula D01 plus G all over market value plus G plus G plus G. So let's continue. So our KE, we have KE, okay, that's what I'm looking for, coming out of equity. So KE is equal to, what's our D0, dividend year 0, what's dividend given to us in the question? Dividend given to us in the question is, where is it? Okay, current dividend of 25 kobo, that is 0.25, open a bracket, 1 plus G, what's our growth rate? 11%, that's 0.11, close the bracket, everything over market value. What's the market value in the question? Market value is currently quoted. Currently quoted market value 1.2 plus G plus the growth rate, that's what? 0.11. So therefore our KE, cost of equity, is equal to 0.25 multiplied by 1.11 is equal to, okay, so divided by, let's do it straightforward, 1.2, everything plus 0.11. So we have 34, 0.34125. Approximately, we now have about 30, to do decimal points, we now have about 34%. So that is how to compute the growth rate using the dividend valuation model and the Dividend Growth Model. I hope you enjoyed this class. So if you have any comment or any question, you can put it in the comment area and let us know. Anywhere you have any challenge, so we can know how to tackle this. So that is how to compute cost of equity, how to compute the growth rate, and how to using the both method given to us that we know, the dividend valuation model and the Dividend Growth Model in computing our cost of equity, in computing our growth rate rather. Because in most times the examiner will not give us the growth rate, we require to do what to compute ourselves, and we have examined the two methods of valuation of determining what the growth rate, which are dividend valuation model and Dividend Growth Model. So from there, we can test to do what? Look for any variable that we are not given. How do you know the formula to use? How do you know the formula to use? How do you know the formula? Look at the question. If you are given growth in the question, definitely you know that the formula to use needs to deal with what? With growth. After that, look at the dividend. Look at the tone of the question. Is it dividend in year 0? Is it current dividend or dividend in year 1? After determining that, you need to know whether the dividend you are going to use will be dividend in year 0 or dividend in year 1. And from there, you can attempt any question, you can solve any question correctly. So in our subsequent videos, we'll be looking at how to use our calculator to do the fifth truth or the fourth truth as the case may be. And also we'll be looking at the cost of, we have looked at the cost of equity, so we tend to be looking at the cost of preference share and the cost of the venture in a subsequent video. Thank you for watching and God bless.